My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank everybody for coming on board and registering today for today's webinar, Alternative and Niche Commercial Mortgage Programs from Emigrant Funding Corporation. Emigrant Funding Corporation is our sponsor today, the sponsor of this webinar. Emigrant Funding Corporation is a subsidiary of Emigrant Bank. Emigrant Bank was founded in 1850 and it is the oldest savings bank in New York City. In addition, it is one of the largest privately owned banks in the country. Emigrant Bank has three divisions that focus on providing real estate lending: Emigrant Realty Finance, Emigrant Mortgage Company, and Emigrant Funding Corporation. Today's webinar is centered on Emigrant Funding Corporation, which is a small balance commercial lending arm of Emigrant Bank. Emigrant Funding is a direct portfolio lender specializing in first mortgage financing for most types of investor-owned and owner-occupied commercial real estate. We are delighted today to have Charles Ruffin as our guest speaker. Charles Ruffin is Vice President and Sales Manager at Emigrant Funding. His primary role at Emigrant is to originate SBA, multifamily, mixed-use, office, retail, warehouse, underlining, co-op, and SRO loans. He also originates residential loans. Before joining Emigrant, Charles worked for companies such as Davenport Capital Markets and JP Morgan Chase and has amassed over 22 years of experience. He holds a JD MBA and a New York real estate broker's license. Charles today will walk us through all of the commercial lending highlights and their role in some of the recent closed transactions. Charles will also talk about the news, recent rate improvements, and after this lecture, we will have Q&A. So even during his presentation, please submit your questions so we'll be ready to ask Charles when he concludes. Ladies and gentlemen, without further ado, Charles Ruffin at Emigrant Funding Corporation. Charles.
Hey, thank you, Anthony, and thanks to all who are attending. Okay, so overall, what we're going to do, like Anthony mentioned, we're going to go over the niche financing programs offered by Emigrant Bank. We're going to start off with just a brief history of the organization, then talk about a couple of the lending platforms, but the majority of the presentation will be geared towards Emigrant Funding Corporation. So as Anthony mentioned, Emigrant Bank was founded in 1850. We're the oldest privately owned bank here in New York City and one of the top 5 largest privately owned banks in the United States. Our headquarters is right in downtown Manhattan, right near Grand Central, and we have 3 real estate lending divisions. So our first real estate lending division is Emigrant Realty Finance, and that's our large balance real estate lending division. That division starts off with a minimum loan amount of $15 million, can go much higher, $100, $200 million as far as through syndications. But overall, it's a bridge platform, nationwide footprint. The type of individuals we deal with here typically are equity, mezzanine, and debt funds, real estate developers, real estate operators, public REITs, private REITs. And typically what this program is, as I mentioned, it's a bridge loan. So you would use a bridge loan more or less to, for example, acquire or refinance a property in which it might not be stabilized. Say you're buying a retail strip center, occupancy, say is vacant or a low occupancy. So you want to acquire it, renovate it, and once it's stabilized, typically we would be taken out by permanent finance. So it's a floating rate loan, a bridge platform nationwide, but really mostly in major metropolitan areas. The second division is Emigrant Mortgage Corporation. This division is our residential division. So it's typically 1 to 4 family, condo, co-op, property types. And we have 2 platforms here. So the first platform is a standard Fannie, Freddie, Mac type of programs, and Fannie Mae. So Fannie, Freddie, like 30-year fix, rate in the upper 2s, for example. A lot of banks have that program, that platform. What makes us different is we have a portfolio program. And with the portfolio program, those are the type of loans we will originate and keep on our books. Some of the highlights we have here with the portfolio program, typically loan amounts up to $10 million, owner occupied or investment. We can actually go higher than that by exception. The largest loan I've seen immigrant finance as I've been here 10 years, it's roughly around $22 million, was for a foreign national who purchased a whole floor of a condo building off of a Billionaires Row in the city for like $22 million. As far as how title can be held, a little bit something that's different. It could be in corporate title or partnerships, say for example, LLCs. We also have a program called the cash flow program for investment properties. So that's basically a business purpose loan in which we can lend up to $10 million. And basically there it's no tax returns, bank statements, verification deposits, or employment. We underwrite it based off of the rent that's in place, or if it's delivered vacant, we use market rent. And the great thing about this program compared to other entities in the space, typically the rates are in the fours, more or less, for a 2-1 or 5-1 arm. We also have a bridge loan program as well for properties that are owner occupied or investment. Basically, this is a scenario where you have a property listed for sale, but you need a loan against that property before it's sold. So that's a bridge loan. We also provide blanket loans as well. So say, for example, you have a borrower that has, 2, 3, 4, 5 properties, just wants one particular mortgage. So we'll have one or more properties with one loan on it. That's a blanket transaction. Foreign nationals allowed. For this particular division, as far as dealing with the portfolio program, it's not a 30-year fixed product. It's an ARM, either a 2-1, 5-1, or 7-1 ARM with a 30-year amortization, and it's a 30-year loan. As far as prepayment penalties, that's only if it's an investment property, and the prepayment penalty there is typically 3, 2, 1. So the next division, that's where we're going to spend the bulk of our time. And we have really a lot of exciting information to give you here, because this division, Immigrant Funding Corporation, is different from any other bank as far as small balance commercial lending. So typically we're looking at loan sizes from 100,000 to 5 million, but we can go higher depending on the scenario. Maximum is $10 million. So this division is different because the mode of financing is we look at scenarios other banks might have turned down, but if we feel comfortable and it fits our criteria, we'll lend on these scenarios. And the great thing is, since we're a bank and our cost of capital is cheap, you could typically look at rates in the 3s or the 4s versus that particular borrower either not receiving financing or the borrower having to go to a private lender paying anywhere from 7 to 10 or 11 points, or as far as rate, plus 2 or 3 points. So we have a competitive advantage in our sweet spot between money center banks and private lenders looking at deals that fit our criteria with some type of situation in which a money center bank might not have financed that request. As far as the property types in this division, I would say 70% of what we're going to finance is going to be multifamily and mixed-use properties, at least 70%. We will look at urban, retail, office, a little bit of warehouse lending, SROs, commercial condos, Condo Act financing, commercial co-ops, underlying co-op loans. As far as other properties considered on exception basis, I've been with the bank roughly 10 years, and the majority, I would say at least 98%, close to 99%, have been primarily the property types you see here with, like I mentioned, a greater emphasis on multifamily and mixed-use properties. As far as the lending territory, so in New York, basically we're looking at the 5 boroughs plus Long Island. Also, we'll lend in Westchester County. On a case-by-case basis, we might lend in Orange, Putnam, Rockland counties. But primarily in New York, a lot of more or less core lending is pretty much Westchester, the 5 boroughs, and Long Island. New Jersey, we'll lend in all counties. Connecticut, Fairfield County only. Massachusetts, you see the counties listed here, but there's a greater emphasis on Metro Boston market. And Florida, basically these counties are Southeast and Southwest Florida. But the majority of the time period when we look at where we lend is pretty much tri-state overall. As far as pricing, so pricing here starts off with our 3-year program. So that can be a 3-year term with additional 3-year terms, a 3-3-3 renewal option. Best starting rate, 3.875%. Maximum loan amount, 5 million, but can go up higher by exception. Maximum leverage with Emigrant, 60% on a purchase, 55% rate and term, 50% cash out. And just to emphasize here, my leverage is less than, say, other money center banks, because typically I'm looking at transactions that have already been passed over by those type of entities. So naturally, I'm not going to be at a 65, 70, 75 LTV if I'm dealing with a situation with has some type of complications with it. As far as debt service coverage, 1.15, prepayment penalty for the 3-year, 531. Credit score, we don't have a minimum credit score. We're going to go into that in more detail later, but in general, the higher the credit, the better the rate. So if I'm dealing with someone with a 575 credit score, of course, they're not going to receive the same rate as someone with a 750 credit score. Amortization is 30 years for this particular program. For the 5-year, so we have a 5-year term as well. You can also do a 5 + 5 + 5 as far as the term. Best starting rate these days, 3.99%. Maximum loan amount, again, like the 3-year, 5 million, but can go up to 10 million with an exception. Same leverage, 60, 55, and 50. Debt service coverage, again, 1.15. Prepayment penalty, 5, 4, 3, 2, 1, longer since you have a 5-year term. Again, we talked about the credit score, amortization 30 years. Now, typically when we look at these type of rates, you're looking at multifamily and mixed use. Once you go into commercial condo, office, retail, it's going to be a little bit higher because of that property type. Again, we emphasize financing more on multifamily and mixed use, so you're going to always have better rates there versus some of the other property types we lend on. So we also offer a bridge loan. Now, when you think of bridge loan, which is a little bit different from Immigrant Realty Finance, our bridge loan basically features, it can be for a property that's delivered vacant, or someone who wants a program in which doesn't have a prepayment penalty. So we don't do any ground up construction. We don't do any gut renovation. So this bridge loan is not the typical type of bridge loan, but it does have some of those features. As far as the starting rate, you're about 5.5%, index is prime. Loan amounts up to 5 million. We do charge 1 point on bridge loans. Unlike on perm financing, 3 and the 5-year, there's no points charged. Maximum leverage, again, for a purchase would be 60%. Interest reserves allowed. Basically, if I'm financing a vacant property, for example, this indecent addition, we're going to have an interest reserve built into there. As far as the term, it's a 3-year term. Prepayment penalty, no prepayment penalty. Another great program we have, and which a lot of other banks don't have these days, is a line of credit program. As far as the rate, you're roughly about 5.5% these days. As far as loan amounts, up to around 5 million. Bank points, just like with the bridge, we do charge 1 point. Maximum leverage, 50%. Debt service coverage, 1.15. Interest only capability. This is the only program we have on the commercial side that is interest only. Terms up to 5 years. Prepayment penalty, no prepayment penalty. And as far as the maintenance fee based upon the unused balance, that's typically 1%. Now, this is a great page here because it gives you the highlights, really how Immigrant is different from a lot of other lenders, and it gives scenarios of why and how. So maximum leverage, again, 60%. The main issue with Immigrant typically is leverage. I turn down more deals because of our leverage than any other reason, because like I mentioned, in private lenders, they can close quicker, higher leverage, but I'm giving better rates. So therefore, I'm not going to be as high on the leverage as, say, a private lender. So we're typically pretty solid on our maximum LTVs. Now, we do protect brokers. What that means is if you have a fee agreement, your mortgage broker or intermediary, we're going to protect your broker fee and pay that at closing. Immigrant also pays a 1% premium or yield spread premium to the brokers as well. So you receive 2 checks at closing. Now, this is only for the perm debt, say, for example, the 3 and the 5 year. It's not applicable for the line of credit or the bridge loan program. So that's another incentive to work with Immigrant. We don't charge any points or application fees. There's an asterisk there. That's basically meaning for the bridge loan program and a line of credit, we do, but for perm debt, there's no points. And overall, we don't charge any application fees, period. Emigrant is not a relationship lender. Some of my other colleagues, their bank is already or moving to relationship lending, meaning when you have a client, your client has to deposit a certain amount of funds, move their stock, bond, brokerage account. So that's relationship lending. We're more transactional. So we don't require any of those additional type of relationships for that client doing business with Emigrant. Quick feedback. I can't say enough about this because dealing with brokers, intermediaries, a lot of time, having that quick feedback is, counterpart. We typically want to, in this situation, give you feedback ASAP. So what that means is if you're dealing with me on a transaction, you call me, I work in the evening, work on the weekends. So you're going to receive some type of feedback regarding your initial request. Also, if it's something that we think, well, I think basically is a good fit, more or less, we're going to give you the documents you need to fill out. And within 24 to 48 hours, you're going to have that feedback from credit and a term sheet to move forward with a loan request. As far as seasoning, we don't have a seasoning requirement. So just say if someone purchases a property all cash, wants to pull cash out right afterwards, that's fine with us. Or it could be more or less a property that's not stabilized. Just say you have a new construction of a property and you're just starting to lease it up. We don't require, say, 12 months of stabilization before you can pull cash out on that request. We don't have any cash out restrictions either. We will look, closely exactly, what the cash out purpose is for, but I don't have a cash out restriction. The only restrictions just deals with our maximum leverage, maximum loan amount, and things of that nature. So some of my colleagues at other institutions, they're not giving cash out, period, and some are, but it might be limited, but we will look at the overall scenario. We will allow seller second. So just say, for example, my leverage 60% isn't high enough. The borrower wants to just put down maybe 20%. So there's a gap there. So if the seller is willing to hold a second mortgage, we'll underwrite that. And as long as the cumulative debt service coverage number works, we'll allow a seller second. Line of credit, we also already mentioned that. Market rent used for debt service coverage ratio. So what this means is we'll actually look at more or less owner occupied units or vacant units, and we can use the market rent that's there when we do our underwriting. So a lot of times certain individual banks might be what's called cash flow lenders. They're only going to lend to the cash flows in place. But, say, for example, you have a vacant building, but is in decent condition, they couldn't do that. With Emigrant, I can use market rent for those vacant units in my overall underwriting debt service coverage ratio. Same thing, if it's owner occupied, I will contribute the market rent to that owner occupied unit as well. Blanket loans, we kind of mentioned that on the residential side, but we can also look at that here on the commercial side. So just say if we're doing a purchase request, for example, the borrower doesn't have all the funds, but they have a free and clear residential or commercial property that fits our guidelines. Or it could be, for example, residential, it could be their primary residence. However way it might be, we can add additional collateral on a purchase request to theoretically do 100% financing as long as that equity is there that fits our LTV requirements. And the same thing on a refinance request. So just say if we're just at 50 and the leverage needed is, say, 60, 65 or higher, for example, and the borrower wants to add additional collateral, that can make the deal work. As I mentioned, dealing with vacant buildings. So a good example, I had a client, he constructed a 15-unit apartment building in Brooklyn, paid cash out of pocket, no construction loan. But what he wanted to do is pull cash out. So he recently had his TCO, but the property was delivered vacant. So it was in great condition, newly constructed. On that scenario, we were able to give permanent financing, 5-year debt, based upon market rent on the vacant units. And with that, we gave him cash out on that request. So the key there is the building was in, good condition. So with that program, we can finance properties that are delivered vacant. As far as credit score, we don't have a minimum credit score, but as always, Someone with a higher credit score is going to have higher leverage, a better rate than someone with a lower credit score. A good example of the scenario would be, I had a deal in which it was a purchase request in Queens. The borrower already owned a mixed-use property, had no debt. They were purchasing another mixed-use property. And the issue here is there were 3 borrowers. And one of them had a credit score in the 500 or so range. So we looked at the overall deal, which you had 2 strong borrowers. So we're able to complete that transaction. The borrowers used the mixed-use property that they own as the equity injection for the property that they were purchasing. So it's really no out-of-pocket expense to them. And we're able to do a blanket loan even with that particular borrower who had a credit score in like the upper 500s. As far as no liquidity minimum, so with Emigrant, we don't say you have to have 10% or 15 or 20% of the actual loan amount liquid, meaning in a bank or stocks and bonds and things of that nature. A lot of times we're dealing with real estate owners, investors, in which they choose to put their liquidity in real estate. So they might not show as much as some other entity, or it could be someone who has, say, weaker tax returns and deal with these real estate investors. They might have, not showing a profit, depreciation for carryover, things of that nature, losses. So that's not a deal killer with Emigrant. We're really going to look at the bigger picture and look at the real estate itself in the overall scenario. So weak tax returns, weak amount of liquidity is not a deal killer. That's just one of the areas we can feel comfortable with as far as looking at other areas of the request, especially our leverage. I can't emphasize it enough. On these deals that have some type of issues with it, leverage allows us to feel much more comfortable than not. As far as clients with a past bankruptcy or foreclosure or short sale, we don't have a problem with that. As long as that's been taken care of in the past, it's not something that's current litigation, we're fine with it. As I mentioned, owner-occupied properties, we can lend to scenarios in which the borrower either lives or have their business in the subject property. A good example, one of my brokers, he had a deal in Chinatown. It was a mixed-use property, and the commercial portion was a restaurant, was open less than a year, and the top portion was just apartments. So it was basically a refi cash out scenario. And of course, the restaurant didn't have good returns, tax returns, because it had been opened for that long. So in that scenario, we just used market rent when we were calculating the debt service coverage. So, that was fine, even though we had the weaker tax returns, the overall criteria fit our leverage, and we were able to close that transaction for that broker. So these are just some of the kind of niche type of scenarios and features that Emigrant Funding Corp is known for and what we can currently do in the market with our niche programs. So what's new at Emigrant Funding? So what we're going to do, like with our next panel, we're going to go into more detail regarding Emigrant Mortgage Corporation, the portfolio programs, plus we're going to go into more detail regarding our new platform of better pricing transactions. Here, as a good highlight, though, as a teaser, more or less. So for the 3-year, we're roughly about 3.25 for a 3-year 3+3 program, for example. And for the 5-year, we're at 3.75. And this is typically just for multifamily or mixed use, but once we have our next discussion, we're going to go into detail as far as the overall criteria. Now, so keys to getting your deal funded through Emigrant. If you can, more or less understand the keys of what is a true Emigrant deal, you'll kind of know and be able to decipher what deal you're going to speak to me about versus a private lender versus a plain vanilla bank. So one is just basically as far as property type. We already mentioned the property type, and typically there's no exception. So again, we're going to look at 70% of what we lend on in this division, apartment buildings, mixed use. Remaining 30%, office, that's, urban office, urban retail, commercial condo, commercial co-op. We will look at condo act financing, underlying co-op financing, SROs, and occasionally warehouses. So that's the property type portion. Time frame, unlike a private lender, we're a bank, so easily 7 to 8 weeks. Also, just dealing with what's going on with, COVID restrictions and things of that nature. You might add like another week or two, but that's the usual time frame. We do require a personal guarantee. So we're not a non-recourse lender. So usually the deals, like I mentioned, have some type of issues in which the individual banks who provide non-recourse financing has already passed on it. So of course, you have a deal that have some issues, you're going to sign a PG as far as the client. As far as leverage, I like to emphasize leverage because with Emigrant, we look at all these, deals with, certain types of issues. But what enables us to do that primarily is leverage. So if I have a client that's looking for a 60 LTV on a purchase max, or a 50 LTV on a refinance cash out request, and they need exactly 60% on the dot and 50% on the dot, for example, I want to make sure to just say if there's some issue with the appraisal not coming in at that number, we have a way to make this transaction work. So if I'm dealing with a broker and I have this type of situation, I will let them know upfront that there needs to be some type of backup plan or just some type of thought given. So if this property doesn't appraise for the number your client thinks it will, how else can we get this deal done? So typically that could either be additional liquidity or additional real estate in which they can add to it. So basically, these are some of the main type of things in which you would want to think about as far as dealing with Emigrant regarding these type of transactions. As far as the process, so I'm gonna go through the process so you have a good idea how the process flow works and kind of go from there. So in general, like I mentioned, if you have a typical Emigrant deal, what you're going to do is we're going to discuss it. If I think it's a good fit, I'm going to email you over 2 attachments. One is our pre-qual form. The second page is just rent roll expense information. And if you already have that information from your client, you don't have to fill out mine. The first page is just general information, loan amount, property address, what type of property is it, what do you think it's worth, credit score of the client. The second attachment is key because I've been doing this over 20 something years. I've seen deals blow up at application, in the middle, right before, commitment or at the closing table. So what we put together basically is a list of questions in which we're trying to have the intermediary, the broker, speak with the client about regarding that particular deal. So if there is issues associated with it, we can find out in the beginning. So you don't have to spend all your time on the file in which would not go forward anyway. So these questions are really for the benefit of the client, benefit for the broker, and the benefit for Emigrant. So you will know if there is an issue, let's discuss it up front, and that way I can have feedback for you ASAP if it is a transaction we feel comfortable with. So assuming that we're okay with the transaction, what happens there is we'll have it underwritten roughly as far as to issue a term sheet within like 24 to 48 hours. So how that works is my analyst will crunch the numbers. I'll do a brief credit write-up, send it to the person above me, then he'll send it to someone in credit. So there are like several different eyes looking at the request. So when we give a term sheet, it's just not a random term sheet. We've had people in credit look at it and other people as well too, to make sure we're at least comfortable with the general information that you're providing. So once you have that particular term sheet and the borrower wants to move forward, you would fill out our application. And once you complete the application, you're going to send it to my analyst. He's going to go over the application. Whatever's missing, incorrect, he's going to highlight it, send it back to you. Because once you have that and you correct it and you send the application in, therefore, we're not going back and forth correcting the application once it's arrived. And once it does arrive corrected, what happens there is the office manager within a couple of days or so, she's more or less going to put it in the file, run credit, and then another set of eyes will look at it. If it's okay there, then it's going to be assigned to an appraiser. And at that time period, my analyst is going to notify you the name of the appraiser and the due date of the appraisal, and that appraiser has 3 days to contact the contact person. So If that appraiser doesn't, we need to be notified ASAP. We'll follow up with the appraiser because it generally takes anywhere from, I would say, 8 to maybe 12 to 13 business days for the appraisal to come back. So while we're waiting for that appraisal to come back, the underwriter is going to issue a stip list. So we're going to work on that stip list. So when the appraisal does come back, we're basically going to have a complete file. Then with Emigrant, the file credit write-up is given to the owner of the bank. So with Emigrant, we don't have, say, a credit committee that meets like, 2 times a month. What happens is whenever we have all the information needed for that final credit write-up, that's emailed to the owner of the bank. Typically within 24 to 48 hours, we'll have feedback from him. And another thing too, since I've been at the bank 10 years, I haven't had one loan in which the owner of the bank declined because we do a lot of legwork ahead of times. I have had counter offers, but I haven't had any loans that he officially said no to because again, we do a lot of legwork up front to make sure it's a win-win-win scenario, a win for the broker, a win for the borrower, and a win for Emigrant to make sure everybody is on the same page. So once we have that approval, then what happens is the file goes to our closing department. That's where a commitment is issued typically within like 2 to 3 business days afterwards. If that commitment is accepted, a 1% good faith deposit is due. So that 1% is not a fee. It's basically refunded at closing. And if it's a large size transaction, it could be 1/4 or 0.5%. It doesn't necessarily have to be 1%. But once we have that, then the bank attorney gets involved. So he'll start reviewing title, start reviewing entity documents, survey, estoppels if required. And then my back office, they will review insurance and any other items that's missing at that particular time period. Another thing about Emigrant is just say if a client needs to close ASAP, we have a rush process. So I could, order a rush appraisal. And also I can have a closing bank attorney start working on the file right at application. So he could start reviewing title, entity documents, and things of that nature, even before we have the commitment. That's another advantage we have here. We have a flat hierarchy, so we can give you quick answers. And if it's something that really needs to move forward, we can quickly, we can move very quickly with it. So after we have all that wrapped up as far as the bank attorney information is all in regarding our back office, everything's there. The file basically will go set up a closing date. And with that closing date, assuming typically either a 3 or 5 year term, the broker intermediary will receive the 1% from Emigrant plus whatever they do charge will collect for them. And also dealing with the client, the good faith deposit will be credited back to Emigrant, credited back to the client at closing as well. So that's the overall process as far as submission process. And currently we are actively lending, looking for deals that fit our criteria with our niche financing programs. Thank you. So Anthony, any questions?
Yes, we do. Charles, thank you very much. Very informative, great presentation. And I'm going to make sure that everybody will get this. Actually, the Office of Immigrant will be sending out a video of this presentation just in case if you missed it or you want to hear it again, as well as Charles's information. We have a few questions here. Plus, we also have questions that people that were unable to make this webinar live. George Theodoro, on the LLC, must it be in first place?
Yes, so I get that question all the time. That's a great question, George. So yeah, Emigrant would never be in a second position on a line of credit. That would be a fabulous product if we had it, but unfortunately, yeah, we would have to be in the first position. So they could either have a line of credit in first position or it could be perm debt, then a line of credit behind it, but yes.
Rohit Malik, what type of asset types are you seeing actively for this market? How do you foresee commercial investment trends in 2021?
Well, as far as asset types, I mean, like I primarily concentrate on, like I mentioned, multifamily, mixed use scenarios. That's the bulk of what I originate. So, that's what I'm concentrating on. But, just like with the previous panel you had, just dealing with slowness in transactions going on, sales and things of that nature, just because of the whole COVID issue, everything is slowed down dramatically. Even though we're in this cycle, I guess it could be considered a cycle, but things have slowed down dramatically, but we are still lending overall. Now, dealing with what's going to happen in 2021, hopefully, as things clear up and the whole issue we're going through and things kind of clear up and somewhat, that there'll be more transactions going on beyond multifamily, mixed use office and retail and things of that nature. So it really just kind of depends on the whole environment, this whole COVID-19 environment we're in, because it's not like the typical real estate cycle that we usually go through. It's totally, abnormal. So no one really knows for sure. We could just only hope for the best. And this is another reason why we wanted to have this discussion, because, like I mentioned, a lot of my colleagues are kind of like on the sidelines, not lending because just dealing with a lot of, bad loans or things of that nature on their books. So we're trying to help the broker community by providing access to programs that are still applicable, that can still allow them to help their clients.
Thank you, Charles.
Sure.
Steve Trowell. Hey, Anthony, how are you? Steve, I'm doing well. Thank you. Ask if the rebate point is disclosed to the borrowers.
No, it's not disclosed, but the broker or intermediary, they're welcome to disclose it if they like, but Emigrant does not disclose it.
Kevin Jones, you mentioned no seasoning on ownership. Just to be clear, investors purchase a property for $100,000, it's worth $300,000. Emigrant will allow a cash out refinance 30 days after purchase?
Well, when we're referring to the seasoning portion of it, meaning that we will allow cash out. Now, dealing with what the appraised value is, that's separate. So we typically look at, if it's like in a 12-month time period, we'll look at the purchase price and we'll look at what the borrower, if they've done any type of renovation work and things of that nature. And we'll also look at market. So no bank wants to be 100% in a deal and cash out all the equity that a borrower has put into a transaction, especially a new transaction. So it depends on that scenario, but we will allow cash out. It just depends on what we consider as far as the leverage and that particular appraised value. But either way, in those transactions in which are, less than a year, I'm not going to ever give 100% of the equity the borrower put into the deal, because certain clients, they'll purchase a property, put like a couple $100,000 into it. Oh, now it's worth 3 times what I paid for it. So that doesn't work, at least with Emigrant. We will look at more market value, more, liberal types of leverage and things of that nature once they've owned the property longer than a year. But if it's just within a year, there are certain restrictions, but we still will allow cash out on that type of scenario.
Good. Edward Lombardo, will you provide a hotel debt?
No, we will not provide hotel debt. So basically, like I mentioned, we're real specific on property type. So like 70% is going to be multifamily, mixed use, 30% office, retail, commercial condo, commercial co-op, condo-act financing, underlying co-op financing, SRO, and an occasional warehouse. So the bulk of what, credit underwriters, the owner of the bank likes, at least in this particular division, apartment buildings, mixed use. But, we will look at the other 30%. But like I mentioned, I've been here at the bank 10 years. I haven't seen them go outside of that particular type of properties that I just mentioned. Maybe they have some other type of situation, but I haven't seen that. It's usually just what I mentioned as far as property types.
An anonymous attendee, what does a personal guarantee entail from the borrower?
Sure. So basically what we're stating is, well, at least with how we see it, more or less. So with a personal guarantee, say, for example, a property like a borrower defaulted and we had to take the property back, and just say if that property was sold and we weren't made whole by that amount that was sold for, there's a deficiency. So a personal guarantee means that what you have in your name personally, that deficiency can go against as far as trying to recoup what we are missing from the original amount of that particular sale when the property was sold. So a personal guarantee, it is significant in a sense in which any institution can more or less go after something that's in your personal name. But like I mentioned with Immigrant, that's, what I've seen since I've been here, more or less, our leverage, 60%, 50%. So if a borrower more or less becomes delinquent or something of that nature, typically it would make no sense for them to go all the way to a foreclosure process. All they would have to do is basically get a private loan in a sense. So that's not really, I would say, applicable to Immigrant, but as far as to answer the question, that's the significance of having a personal guarantee in which someone can go after other types of assets that's in the borrower's personal name.
Thank you, Charles.
Sure.
Roy Fenishy, and I apologize, Fenichel. Clear and concise, well done, Charles. Question, can you combine income streams and collateral for business property loans?
Business property loans. So as far as owner occupied, we can do that. So just say if it was a commercial condo or something of that nature, owner occupied. But just say if I'm looking at underwriting that and it doesn't work regarding like market rent, for example, and the borrower does have a strong business, things of that nature. Usually, I would say not. We're pretty much going to go after what it underwrites for in a sense, but I wouldn't necessarily say that all the time. I have seen situations, like a good example, I had a deal in Brooklyn Heights. Beautiful property. It's like a 7-family property. And the issue there is several of the units were occupied by the owner's relatives. So they had below market rent. And the issue is the borrower was trying to pull cash out, and he went to a regular bank who just does the standard, cash flow analysis and things of that nature, in-place cash flow. And as I recall, it was like 2.3 million. But how we looked at it, we were able to do that deal below a 1.0 debt service coverage because we looked at, one, what market is, and two, the personal financial statement and strength of that particular borrower. So we had a couple of great things going here. We had a very solid borrower with significant business income, a great property, a lower leverage deal. So in that scenario, we were able to go outside our standard debt service coverage to do a deal below 1.0, and we got that deal done, and we're able to pull the cash out the client was looking for, because a typical cash flow lender couldn't necessarily come up with the amount of dollars for that particular deal. So Roy's question is kind of like a yes and a no scenario. It really depends on the scenario, the leverage, the property type. Then you have to look at the sponsors, PFS, and things of that nature. But overall, we're going to try as best as possible to make a deal work. Usually how we accomplish that is through cross-collateralization. So if the typical loan amount doesn't work in general, we always say, okay, any other additional collateral, owner-occupied property like residential, 1 to 4 family condo, for example, or any other commercial real estate, will cross it. That's usually how we get over that hurdle.
Thank you, Charles. Kamraj Saju, can we provide our own credit reports?
No.
Ski, on the EFC website for small balance commercial, it shows Eastern PA included, Philadelphia. That was not on the earlier slide showing where you lend. Has there been a change?
Yes. So currently, that's not part of our, lending territory. Because I've had deals, in the Philadelphia market, and basically, because of what's going on currently, they weren't willing to review those transactions. So that's why we didn't include it.
Michael Hofstein, how often do you send out the rate sheets? I have not seen one in a very long time.
Well, that's how it works. On the commercial side, there's no set rate sheets in which we would send out. Residential side, with portfolio, agency, that goes out daily. But typically you would get in contact, whoever your particular representative is at the bank in this particular division, and then they would give you information on the rate sheets and things like that. Just like with this presentation, there's another one, pretty much, it's like more, it has a couple other different slides, but it's the up-to-date rates. So we don't publish them daily on the commercial side, 'cause primarily a lot of times they very rarely change. But the best thing to do is whoever that person's rep is, they could easily give them a good idea of what we're currently lending as far as rates.
Great. David Baldwin, when you have a multi-member LLC, what's the criteria level of ownership percentage for info on the LLC members versus just the JP?
Sure. So how it works with Immigrant, anyone that owns 10% or more, I got a package. So, you know, that's the criteria. If you own 10% of that LLC or more, we're going to look at PFS, credit authorization. Basically, I'm packaging you as far as your particular information that we have to provide. So typically that's, as far as information that we will require, 2 years tax returns. If you're self-employed, you might have 2 years of business returns as well too, 2 years personal returns. So we package those individuals who have that 10% or more ownership.
Thank you, Charles.
Mhm.
I know Pedora Moy wanted you to answer Roy Finishel's question, and I hope she got the right answer. If not, Pandora, you could resend and submit a question. We have Michael Hofstein again. Will you require municipal searches, and will you allow an escrow to clear violations?
Yes and yes. So as far as escrows, I could have put that on like the highlight slide. So I've closed deals with multifamily properties, 100 and plus, like HPD violations. So that's another thing in which we're flexible with, especially if there's a good explanation. So what we would do is we would close, we have some type of escrow, and once those violations are cleared, and then we basically release the escrow. So it kind of depends on the scenario. So we have closed with borrowers who don't have a C of O in place. That's like the hardest one to clear, especially these days with the DOB and, as far as the hours and trying to get somebody to, work there. But we have scenarios in which we can finance properties that do not have a valid C of O, or properties in which, have a significant amount of violations. So just like mentioned, we basically have an escrow, hold that back a portion taken out of the proceeds. And once, the amount of violations meets our criteria, then we will release that particular escrow for that amount.
Great, thank you. Ski said, great job. Thank you, Ski. We have about 4 more questions that came in last night because they were unable to join us live today. Explain YSP, and is the YSP disclosed on the closing statement?
Sure. So we kind of mentioned that. So the YSP, that's typically the yield spread premium. So that's 1% of the loan amount, which comes from immigrant's pocket to that intermediary, to the broker. And another thing about the YSP, even if the broker, as I mentioned, even if they decide not to take it, basically it doesn't affect the rate. So if you don't take it, fine, you're not going to get a lower rate. If you do take it, fine, it's going to be the same rate. And it's not disclosed, on the closing statement as well too. But the broker or intermediary is more than, if they want to disclose, that's fine. That's up to them.
All right, great. So I guess that answers the second question. If the YSP is not taken, can the rate decrease? So that answers that question. Thank you, Charles. Another attendee, any COVID-19 holdback restrictions?
Yes, that's a great question. So typically what we have now, just to make underwriting feel comfortable regarding what's going on. So as far as the COVID holdback restrictions, it's based on a personal financial statement. So one person that has a weaker PFS, and it could be based also on vacancies within a building itself too. So generally, 12 months Could it be less than that? Yes, with a significant PFS, if we feel very comfortable about that particular client. Could it be more than that? Just say if you have a retail property with a lot of vacancies, yes, it could be more than 12 months. But in general, yes, we do have that requirement.
Great. Two more questions, Charles, and I think we're going to conclude here. When is phase one required?
Sure, another great question. So phase one is required with immigrant based upon the loan size. It's not even based upon the property type. So even if it's apartment buildings, mixed use, once you hit, 500,000 or more as far as a loan amount, a phase one is automatically required. So that's what triggers the phase one, the actual loan size.
I guess this is a very important question here. For a commercial mortgage broker who has not worked with immigrant in the past, does the broker have to be approved by the bank in order to submit new loan requests?
No, on the commercial side. On the residential side, say for our business purpose loan, certain banks, they would put that type of transaction in their commercial division and wouldn't necessarily require any type of broker package. So on the commercial side, Immigrant Funding Corp, no, we don't require a broker to submit a package to be approved or anything of that nature. It's deal by deal, as long as you have your fee agreement, it's transaction based. Residential, if you come across a scenario that fits our cash flow program, then there is a submission process required. Like I mentioned, we're kind of we're kind of odd in that extent because most banks don't require for an investment residential property, 1 to 4 family or condo, in an LLC to require that particular broker to submit a package, but we do. But again, if it's just Immigrant Funding Corp, apartment buildings, mixed use, office, retail, and the other property types, we do not require a broker package.
That's great. I think that's it, Charles, and this was very good. I know that Immigrant Funding Corporation has 2 more. They have a series with our firm. At this point, Charles, do you have an idea what those 2 topics might be, or are we still undecided?
No, sure, I have a good idea. So the next one, which will be, in January, and all the attendees here, you'll receive information on it. So it's going to go over more of the Immigrant Mortgage Corporation portfolio program that I briefly mentioned about, and dealing with that, just more information on that cash flow program, which is a business purpose loan that doesn't require borrower tax returns, bank statements, things of that nature, which is an excellent program. Like I mentioned, there are other programs out there, but I think where we set ourselves apart from is just dealing with our rates, which is typically, I would say, mid to upper 4s for a cash flow type of program. And also we're going to go into more detail dealing with the new programs we have for the better pricing. It's called select pricing. We mentioned that briefly with the 3-year and a 5-year better pricing. So, we're going to go over that, and that's the second one. The third one, we're basically going to look at some type of lender panel. So I have a couple of my colleagues who provide alternative mortgage financing because no institution does everything. So like with myself, if I deal with a broker intermediary, for example, and they have a deal and I have a colleague that I think is a better fit, or it's like a property type, for example, that we don't lend on, I probably I give a ton of referrals because like I say, what goes around comes around. So if it's a scenario that a broker has and they need a viewpoint of who might have a better program or a program, I'm more than willing to discuss it and give them a referral to some of my colleagues who might have the program they're looking for. So that panel would basically be more or less alternative financing panels, each one doing something different than the other, but has unique programs. So it's going to be probably 3, maybe I would say 3 or 4 individuals, some more than I would say 4, but maybe 3 alternative commercial lenders. And that's what that panel is going to be about, the third one.
That's great, Charles. Some of your fan club is sending in messages. Steve Trow, great Charles, great job, Charles. And also Elliot Aguilar from Ponce de Leon. Great job, Charles.
Thank you.
So yeah, thanks guys. Once again, Charles, thank you so much. Thank you, Immigrant Funding Corporation, as sponsoring this panel. And I hope everybody has a great day.
Yeah,
Thank you.
you're right. Thank you. Everyone take care. Bye.
Thank you. Bye-bye, guys.